If you own Bitcoin right now, you are about to go through one of the most psychologically brutal 90-day periods of this entire cycle. And almost nobody is prepared for what's coming. Because while everyone online keeps screaming about the next breakout, Bitcoin just failed the single most important level on the chart. Not once, not twice, 3 times. 3 rejections in 3 weeks. And every single rejection is telling you the same terrifying thing. The financial system underneath the market is starting to crack. Not Bitcoin, the system. Bitcoin is sitting around $78,000 right now, and people think this is just another normal pullback. It's not. What's happening underneath this market right now is the exact same type of pressure that historically forces governments into emergency responses. And when that response finally comes, the people panic selling this summer may end up watching Bitcoin explode without them. Because here's the crazy part. The thing dragging Bitcoin down right now may become the exact thing that sends it violently higher later. That's the part almost nobody understands. And by the end of this video, you're going to see why Bitcoin keeps failing this level. The hidden force controlling the entire market right now. Why mortgages, car loans, inflation, and Bitcoin are suddenly connected. And why this summer could become the setup for the biggest liquidity wave since 2020. It is the full picture. The macro machine that is controlling Bitcoin's price right now, and why the same machine that is crushing it today could eventually send it violently higher. There are 4 dominoes falling right now in sequence. And by the time I walk you through all 4 of them, you will understand this market in a way that most retail investors never will. Stay with me, because this is where it gets really important. But first, if you are new here, welcome to the Wealth Continuum. This channel exists for one reason, to give you the financial context that most people never get access to. If that sounds like something you want consistently in your life, hit subscribe right now before you forget, because we publish content designed to help you think differently about money, markets, and wealth. This video is for educational and informational purposes only. Nothing here constitutes financial or investment advice. Always do your own research and consult a qualified financial professional before making any investment decisions. Crypto assets are highly volatile and carry significant risk. Let's get into it. Everything happening to Bitcoin right now, every rejection, every red candle, every liquidation cascade, traces back to 4 interconnected forces: war, oil, inflation, and the bond market. 4 dominoes, one chain. And every single one is making the next one worse. Let me walk you through them one by one. Domino 1, the Strait of Hormuz. This is one of the most strategically critical waterways on the planet. Nearly 1/5 of the world's daily oil supply passes through it. 1/5. And right now, it remains deeply unstable following the Iran conflict that ignited earlier this year. The US-Israeli military engagement with Iran began in late February of this year, and the shockwave from that single event has not stopped rippling through the global economy. Think about what that means for a moment. One stretch of water in the Middle East, and the entire global energy market holds its breath every single day. That is the fragility of the world we live in. Now here's the terrifying part of Domino 1. Domino 2, oil. Brent crude is currently trading above $114 per barrel. West Texas Intermediate is above 106. According to the U.S. Treasury's own borrowing advisory committee, oil prices are now up roughly 80% since the start of 2026 alone. 80%. Let that land for a second. And I want you to ask yourself something while I keep going. Are you personally feeling this in your wallet already? The grocery bills, the gas pump, the cost of your Amazon packages? Drop a comment below and tell me what is hitting you the hardest right now. I genuinely want to know what people are experiencing on the ground, because oil is not just gasoline. That is the mistake most people make. Oil is the invisible tax on everything. It is in your food supply chain. It is in every airline ticket. It is in the diesel that powers every truck that delivers every product in your country. It is in the fertilizer that grows the food you eat. It is in the plastic wrapping that product came in. When oil surges 80% in 5 months, everything reprices. Quietly at first, then all at once. Which brings us perfectly to Domino 3. Domino 3, inflation. The Consumer Price Index report for April 2026 was not just bad, it was shocking. Annual CPI came in at 3.8%. The highest reading since May of 2023. Core CPI, which strips out food and energy, came in at 2.8%, above what economists expected. And the Producer Price Index, which measures what businesses pay before those costs get passed to you, came in at 6% year on year. 6%. This matters enormously because the PPI is a leading indicator. What businesses pay today becomes what you pay tomorrow. The pipeline of inflation is still flowing, and it is accelerating. The whole yield complex is driven by inflation and oil right now, said Scott Bokta, head of fixed income strategy at Brain Capital this week. People are just starting to price in more inflation. But here's what they are not telling you. The fourth domino is the one that actually controls Bitcoin. And almost nobody in the crypto space is paying enough attention to it. Domino 4, the bond market. Stay with me here, because this is where the entire story lives. I know what some of you are thinking. Bonds are boring. Why should I care about bonds if I own Bitcoin? Because the bond market is not boring right now. It is on fire. The bond market is the price of money itself. It determines what it costs to borrow. And when the bond market breaks down, everything breaks down with it, including Bitcoin. Here is what has happened this week. The 10-year U.S. Treasury yield surged to 4.6%, its highest level in a year. That spike capped what Bloomberg described as the biggest weekly jump in bond yields since President Trump's tariff shock in April of 2025. And the 30-year Treasury yield? It broke above 5%. Now, why does this number matter to you? Because the 10-year yield is the benchmark. It is the number that mortgage rates follow. It is the number that car loan rates follow. It is the number that credit card rates reference. When that number goes up, America gets more expensive to live in instantly. Mortgage rates climb. Monthly car payments rise. Credit card minimum payments grow. Business loans become harder to justify. Every single borrower in the country feels this, even if they never look at a bond chart in their life. And simultaneously, risk assets get repriced lower. Tech stocks, growth stocks, and yes, Bitcoin. But let me ask you something more uncomfortable. Why are yields rising so aggressively right now? The standard answer is inflation. And yes, that is part of it. But the deeper answer is something that should genuinely concern every single person watching this video. Fewer buyers want to lend money to the US government. Think about what that means. The United States government issues debt constantly. And historically, the world has lined up to buy it because it was considered the safest investment on earth. But now, buyers are demanding more compensation, higher yields, just to hold American debt. And there's a reason for that. Comment below if you want me to do a full dedicated video on the US debt spiral. Because what I am about to explain in 60 seconds deserves 2 hours of its own content. Here is how a debt spiral works. And once you understand this, you will never look at economic news the same way again. The government spends more than it collects in taxes, so it borrows to fill the gap. But borrowing more means issuing more bonds. More bonds flooding the market means bond prices fall, which means yields rise. Rising yields mean the government pays higher interest on its existing debt. Higher interest payments make the deficit even larger. A larger deficit means even more borrowing, and the cycle feeds itself over and over and over again until something breaks. The United States is not approaching this problem. It is already inside it. Interest payments on the national debt are now one of the single largest line items in the entire federal budget. The country is spending an enormous amount every single year just on interest. Not on defense, not on healthcare, not on infrastructure, just on the cost of money already borrowed. And here is the detail that should make you stop and think. The U.S. is now approaching a point where it may need to borrow money simply to pay interest on money it already borrowed. How is the weather where you're watching this from, by the way? Drop it in the comments. I always love knowing where the wealth continuum community is tuning in from around the world, because I want to be real with you here. This is not a partisan political point. This is math. And math does not care about elections or party affiliation. The numbers are what they are. And right now, the bond market is beginning to reflect those numbers in a way that is impossible to ignore. This is where it gets really concerning. Because the bond market is not just a number on a screen, it is the foundation that every other asset in the world is priced upon. And when that foundation develops cracks, everything built on top of it shakes. Bitcoin is shaking right now. But stay with me, because the next section is where most people completely misunderstand what is happening. Let us come back directly to Bitcoin. Bitcoin is sitting around $78,000 today. Its all-time high was $126,200, set in October of 2025. That is a drawdown of over 38% from the peak. And over the past several weeks, Bitcoin has been grinding into a specific resistance zone repeatedly and getting rejected from it. Every time buyers push the price higher, sellers come in and kill the momentum. Why? Because there is a very specific group of people trapped in this market right now. Short-term holders. People who bought Bitcoin somewhere between $80,000 and $120,000 over the past several months. Every time Bitcoin rallies toward their entry price, they treat it as an opportunity to escape, to get out, to stop the bleeding. And that selling pressure is relentless, because there are a lot of people in that situation. Simultaneously, look at what else is happening in the broader market. Earlier this week, crypto longs lost $500 million in a single liquidation cascade as Bitcoin slid towards 78,000. Harvard University this week cut its Bitcoin ETF stake by 43% and exited its Ethereum position entirely. Stocks are rolling over, tech is weakening, mining stocks are getting crushed. This is not isolated Bitcoin weakness. This is a system-wide repricing. And here is the question I want you to genuinely think about and answer in the comments below. Are you holding, buying the dip, or pulling back right now? I'm not asking for financial advice. I genuinely want to understand what the community is feeling at this moment. Be honest. Because here is what I know about markets. They bottom when the last seller sells, and they top when the last buyer buys. Sentiment matters enormously. Right now, the fear and greed index for Bitcoin is sitting at 31, squarely in fear territory, which historically has been more interesting for buyers than for sellers. But, and this is critical, fear can deepen before it resolves. What does deeper fear look like? $70,000 becomes possible. $65,000 is on the table if the macro backdrop deteriorates meaningfully from here. I will not sugarcoat that for you because this channel is about honest analysis, not hopium. But here is what they are not telling you. The same force destroying Bitcoin right now may be the exact force that eventually supercharges it. And this is the part almost nobody is thinking about. Subscribe if you want to see more analysis like this, where we connect the dots between global macro and your portfolio. Because the mainstream financial media never does this work for you. Imagine being the person who has to navigate this disaster. That person is the Federal Reserve Chair, and whoever sits in that seat right now has inherited one of the most difficult macro environments in recent memory. There are no good options, only bad ones and catastrophic ones. Option 1, cut interest rates. This sounds great for markets on the surface. Lower rates, risk assets, rally, Bitcoin pumps. But cutting rates while inflation is running at 3.8% and oil is above $100 a barrel, that is gasoline on a fire. You risk completely reigniting the inflation that has already taken years to partially suppress. The Fed cannot credibly do this right now without destroying its own credibility. Chris Rupke, chief economist at FWD Bonds, said this week after the CPI print, "Today's inflation report is certainly another nail in the coffin of the idea that Fed officials have to welcome the new Fed chair with an interest rate cut this year. In fact, the CME FedWatch tool is now pricing in a 25% chance of a rate hike by December. Not a cut, a hike." Pause on that. A hike. What does that mean if it happens? It means financial conditions tighten further. It means bond yields push even higher. It means the pressure on risk assets, including Bitcoin, intensifies. Option 2, keep rates high. This keeps inflation somewhat in check, but accelerates the government's debt problem. Higher rates mean bigger interest payments on the national debt. Bigger payments mean a bigger deficit. A bigger deficit means more bond issuance. More bond issuance means more downward pressure on bond prices. It is a slow motion trap. Option 3, and this one is the most important, financial repression. This is the option that governments throughout history have quietly chosen when they found themselves in this exact trap. Financial repression means keeping interest rates artificially below the true rate of inflation. Not cutting rates dramatically, not hiking them aggressively, just holding them in a position where inflation is slowly, quietly eroding the real value of the debt. What you own loses purchasing power slowly. What the government owes becomes cheaper in real terms over time. Savers get quietly destroyed. Debtors, including the government, get quietly rescued. And the playbook for financial repression requires one critical ingredient above all others: liquidity, new money entering the system. And here is the question I want you to sit with right now. And I mean genuinely sit with it, not scroll past it. If the government eventually needs to inject massive liquidity into the system to prevent a bond market collapse or a financial crisis, where does that money go? Where did it go in 2008? Where did it go in 2020? Where does freshly created money historically flow when fear peaks? Into assets with a fixed, finite supply. And Bitcoin has the most rigidly fixed supply of any asset that has ever existed in human history. 21 million coins, maximum, forever. No government can change that. No central bank can dilute it. No crisis response can print more of it. Stay with me here, because this is the part that separates people who think one layer deep from people who think 2 layers deep. The first order effect of everything I have described is completely visible right now. You're watching it happen in real time. Fear, tighter liquidity, markets selling off, Bitcoin down 38% from its high, crypto liquidations, institutional retreats like Harvard cutting Bitcoin positions, volatility exploding, panic headlines. This is the first order effect, and it is real, and it hurts. But what is the second order effect? The second order effect is what happens after the first order damage becomes so severe that the system cannot sustain it. Because here's the thing about financial crises. They do not just keep getting worse indefinitely. At some point, a different point for every crisis, but always some point, the pressure becomes so overwhelming that policymakers are forced to respond. Think about 2008. The financial system was collapsing. What happened? The Federal Reserve and U.S. Treasury launched the most aggressive liquidity injection in modern history to that point. Think about March of 2020. COVID hits. Markets crash 40% in weeks. What happened? An even more aggressive liquidity flood. Trillions of dollars. Rates to zero. Quantitative easing on a scale never seen before. Think about the regional banking crisis of 2023. Banks start failing. What happened? Emergency lending facilities, backstops, liquidity, different trigger, same ending, every single time. The question for Bitcoin is not if this liquidity cycle eventually comes. It is when. And what will Bitcoin do when it arrives? Hit like if you believe that moment is coming. I want to see how many people in this community are thinking beyond the current cycle of pain, because the chart right now looks brutal, and emotionally it is exhausting to hold through this. But the people who sold gold at the bottom of every inflationary crisis in history looked smart for about 12 months. Then they spent the next decade watching what they sold, quietly, become the best performing asset of the era. I am not saying Bitcoin is gold. I am saying the dynamic rhymes. And here is what nobody is pricing in right now. Japan, historically one of the largest foreign holders of U.S. Treasury bonds, has been reducing its exposure to American debt. If that trend continues and foreign demand for U.S. Treasuries continues to weaken, the Federal Reserve eventually becomes the buyer of last resort. And when the Federal Reserve buys bonds, it creates money, new money, fresh dollars entering a world where Bitcoin's supply is capped forever at 21 million. You do not need to be a macroeconomist to see where that story ends. But timing it, that is the hardest thing in markets. And I will be honest with you. Nobody knows exactly when this transition from phase 1 to phase 2 happens. Anyone who claims certainty is selling you something. What I can tell you is this. The setup is being built right now in real time, whether you're watching it or not. So what do you actually do with all of this? Because information without a framework is just anxiety. And I want to be careful here. This is not financial advice, and I need to say that clearly. Everyone's situation is different. Your risk tolerance, your time horizon, your financial obligations, these all matter. Please always consult a qualified professional for decisions that affect your real money. But I can give you the framework for how intelligent, patient investors tend to think about moments like this historically. First, they separate emotion from analysis. When the fear and greed index is at 31 and headlines are screaming panic, that is precisely when the emotional crowd is most likely to make decisions they will regret for years. The crowd bought at $90,000 in euphoria. The crowd is considering selling at $78,000 in fear. Smart money tends to do the opposite of the crowd at extremes. Second, they think in phases. Phase 1 of this environment is what we are in right now. Liquidity tightening, risk assets repricing lower, pain. Phase 2, which may come in months or in a couple of years, is the response. Liquidity expansion, money creation, scarce assets repricing higher. The investors who get destroyed are the ones who mistake phase 1 for the permanent state of the world. Third, they size their positions for volatility. If Bitcoin dropping another 15 to 20% from here would force you to sell, then your position is too large for your psychology. A position you cannot hold through turbulence is a position that will hurt you at the worst possible moment. Fourth, they zoom out. Bitcoin is at $78,000 today. 3 years ago, it was at $25,000. 5 years ago, it was below $40,000 on its way up. The people who are most anxious about Bitcoin right now are often the ones with the shortest time horizons. Long horizon thinking changes the entire picture. And while you are thinking about all of that, let me ask you something that has nothing to do with Bitcoin for a moment. What are you doing right now while you're watching this? Are you on your lunch break, in bed, on a commute? Drop it in the comments. I always love knowing when and where people are watching. It makes this feel less like content and more like a conversation. Here is something practical you can actually use. The transition from phase 1, liquidity tightening, to phase 2, liquidity expansion, does not happen silently. It announces itself through specific signals in the market. You do not have to predict it perfectly. You just have to recognize it when it starts. Watch the Federal Reserve's language. When the Fed begins softening its tone on rate hikes, when words like data dependent and reassessing start appearing with increasing frequency in FOMC statements, that is the beginning of the pivot signal. Watch the 2-year Treasury yield. The 2-year tracks short-term rate expectations extremely closely. When the 2-year starts falling meaningfully while long-term yields remain elevated, that is the bond market beginning to price in a policy reversal. Watch the US dollar. When the dollar weakens meaningfully, and it has already shown signs of pressure this year, risk assets including Bitcoin have historically benefited. A weaker dollar makes hard assets more attractive globally. Watch Bitcoin's on-chain data. When long-term holders, the wallets that have held Bitcoin for over a year and have historically been the smartest money in the market, stop selling and start accumulating. That is a signal worth paying attention to. None of these signals are flashing green right now. They are not. I want to be completely straight with you. The current environment is genuinely difficult for Bitcoin in the near term. But here's the thing about storms. They do not last forever. Every single one of the macro crises I mentioned earlier, 2008, 2020, 2023, felt permanent when you were inside them. The fear was overwhelming. The headlines were terrifying. The smart people were confidently predicting years of continued pain. And then the storm broke. Let me bring this all together for you now. Right now, on May the 17th, 2026, here is what we know for certain. The Strait of Hormuz remains unstable following the Iran conflict. Oil is above $114 per barrel, up roughly 80% since the start of this year alone. Consumer prices in the United States are rising at 3.8% annually, the fastest pace in nearly 3 years. The producer price index is surging at 6% year on year. The 10-year Treasury yield just hit its highest level in a year at 4.6%. The 30-year Treasury is above 5%, and Bitcoin has fallen 38% from its all-time high of $126,000. Those are the facts on the ground today. And the temptation, when you look at all of that, is to panic, to liquidate, to walk away. But I want to leave you with one final question to sit with. In a world where governments cannot stop spending more than they collect, where debt levels are approaching mathematical breaking points, where every financial crisis in the past 2 decades has ended with the same policy response. More liquidity, more money creation, more currency debasement. What is the single asset that was engineered from the ground up to be the opposite of all of that? Fixed supply. No central issuer, no government control, no inflation, no bailouts, no dilution. 21 million coins, forever. The people selling Bitcoin this summer may look smart for a while, and they might even be right in the short term. A deeper flush is absolutely possible, and I will not pretend otherwise. But the moment that this macro storm forces the eventual policy response, and history says that moment always comes, the same people who sold may spend the next few years watching an asset they understood but could not hold do exactly what it was designed to do. That is the part that is hard to explain to someone until after it happens. And that is exactly why the wealth continuum exists, to give you the framework before the moment arrives, not after. Share this video with someone who needs to understand what is actually happening in this market right now. Not the surface level noise, the actual mechanism. Because most people are navigating this with nothing but fear and Twitter threads. They deserve better than that. And if you want to keep going deeper with us, if you want more of this type of macro-connected, honest, no-hype financial thinking, then subscribe to the Wealth Continuum right now and turn on notifications. We are building something here that I genuinely believe will be valuable to you over the long run. Until then, stay patient, stay informed, and stay in the continuum. The Wealth Continuum, understanding money before the moment arrives.